Hi, welcome to the personal finance course. Welcome back. This is the second section of the chapter on stocks. In the first section, we talked about why we should have an equity bias in our investing, why stocks produce returns, how they produce returns greater than others. We called that the equity risk premium, greater than other securities. We also talked about what they are, how to categorize them, where the returns come from. In this section, we're going to talk about how do we choose stocks, what do we look for, or funds that own stocks. We're going to talk more about mutual funds in a future chapter, but how do we evaluate stocks? How do we find good ones over bad ones? We're going to talk about a really important theory that impacts all of investing called the efficient markets hypothesis. And we're going to wrap up with some recommendations in this section on how to make your own investment decisions. So how do we determine value? How do we figure out which stocks to buy? Well, look at market value like share price. Look it up online, look it up in newspapers. Cell phone news used to be that only experts knew share prices, and we had to go to special machines at an investment bank or a brokerage firm to look up share prices. Now share prices are everywhere. All on your cell phone. People know higher increases in share prices and higher prices are better than lower. So most common, most immediate, some argue because it's set by the market, buyers and sellers, the most accurate way of determining the value of a stock. Intrinsic value, it's the finance-based approach, is the present value of the future cash flows. Now that sounds very fancy, right? And you discount future cash flows back to the present using an appropriate discount rate. What that means, in effect, is it's using techniques that we learned in our chapter on time value of money. But in general, what it means is you make predictions about the future cash generating ability of the business, and then you bring them back to the present and add them up, discounting by a rate such that the ones farther in the future have less impact than the ones closer to in the future. The point is that this is a finance way of trying to determine an intrinsic value. It could differ from the market value, this intrinsic calculated approach. And another way is a book value approach, which is accounting based, which is to take shareholders' equity, meaning assets minus liabilities. You would divide shareholder equity by the shares outstanding to get a price per share. It looks really more to current measures where the finance-based present value of future cash flows is really more forward-looking. So these are a couple of ways. Market value is what it's actually priced at based on buyers and sellers all over the globe right now. The other two methods give you a way to calculate an intrinsic value approach so you can compare what the market price is, which may be affected by global wars, economy, behavioral biases, those kinds of things, versus what you calculate to be the value of the stock. How do we evaluate relative prices? Well, one way is using a measure called price to earnings ratio. It compares the company's market price, we just talked about, to its earnings per share. Current price earnings approximations, the Standard & Poor's 500. This is a group, a list of 500 stocks put together on a proprietary basis by Standard & Poor's Corporation. The price earnings ratio is currently 20. Some people would call it 20 times, meaning price of 20 times $1 of earnings. Google and Microsoft are both 24 right now, a little higher than the S&P 500. Apple is 16, a little less than the S&P 500. And Amazon is 65. 65. Why is this true? Why would people pay $65 for $1 of Amazon's earnings and only pay $16 for $1 of Apple's earnings? Why? Well, the reason is because people think Amazon share price is going to grow more, grow faster. As I'm recording this, we're in the middle of the coronavirus, social distancing, and Amazon still has to sell products. Maybe the market thinks that you don't need another iPhone right now, but you certainly need milk, eggs, fruit, vegetables, those kinds of things. And in fairness, these price earnings ratios are probably historical, so they probably aren't immediate, probably not right now, but reflect even larger people's views about the growth of Amazon and its product and service versus, say, Apple's. Price to book ratio is another way to look at it. It compares a company's market price to its book value. Its book value being its shareholders' equity, assets minus liabilities. It's accounting driven. And here's some definitions. The market price per share, is it higher or lower? Is it increasing or decreasing? How's it compared to others in its industry? You look that up on your phone, newspaper, whatever. Earnings per share is the company's net income divided by shares outstanding. It's an important measure of how well a company is run, the earnings, because you take sales less expenses and what's left is net income or earnings. It's just like the cash flow statement that you put together in an earlier chapter where you took inflows less outflows equals surplus or deficit. Same thing. And last, book value, company shareholders' equity is equal to assets less liabilities. Price earnings ratio was one of the most common ways you're going to see people deciding what's the better way to look at it. One example before we leave this slide, think of sneakers. Why do you pay $80 for one pair of sneakers, $150 for another, and $350 for another? The $80 might be the most durable ones. Probably most people pay for these. $150 might be for the fancy, high top, colorful, fancy running shoes, basketball sneakers. $350 you might pay for ones that are aligned with a designer, Kanye West or something like that. Are they really worth more? Well, if people were paying for them, maybe. And the same thing is true for stocks. In the case of Amazon, 65 times, people believe its earnings are going to grow faster than they believe Apple's or Microsoft or Google's. How do you learn about stocks? You read about them on news platforms like the Wall Street Journal, New York Times, Bloomberg, Yahoo Finance, certainly blogs and podcasts. Take an interest in the companies that make things or provide services that you like and use. Follow them. Find out what's happening with the new iWatch. Is it going to work or no? How about the new Amazon service where you don't have to pay? You just walk in, swipe, and walk out. How well is it doing? Follow simple things about these companies like their sales, their earnings, their competitive situation, and their product or their service. Okay, the efficient market hypothesis was developed by a number of people, including Paul Samuelson, who's written economics tests, Eugene Fama. There are people even in the 1800s that didn't contribute specifically to this hypothesis, but whose work impacted this hypothesis. And the idea is that stock prices reflect all the available information. Market prices are the correct price, and stocks always trade at fair market value. If this is true, then it's impossible to beat the market. The stock price offered in the market is the correct price. It's the fair market value. No one can choose stocks that beat the average market return. And if that's true, if this second point is true, then you should only invest in passively managed index funds that pay very low costs when you do so. Let's go through it again. Market prices are the correct price because people are buying and selling all over the globe, and collectively they know all there is to know about the stock. This is a hypothesis now, a theory. We're going to talk about how widespread and how agreed upon it is in a moment. If that's true, it's impossible to beat the market, the theory says. No one can choose stocks that beat the market if all the available information is included in the share price. And if that's true, then you should only invest in passively managed funds. And we talked about what passive and active are in the investing fundamentals chapter, but it's just a list. It's an attempt to get the average return of whatever that list represents. Standard & Poor's 500, for example, represents the U.S. stock market. And you should pay low cost to do it because low costs means the difference between the gross return and the costs is the net return. And so pay low cost doing so. Now, is it true, the efficient market hypothesis? Take a look. Look at Warren Buffett. The blue line is his returns from 1987 to 2000 on the left. In the middle, 2000 to 2007. On the right, 2007 to 2019. He's beaten them handily in 2 out of 3 of these and even beaten them in the far right one. So if people like Warren Buffett can beat the market, what does that say? Well, let's take a look at the bigger picture. Notice that for actively managed funds, I'm looking at the chart on the left at the top. For actively managed funds, only in 2009, roughly 50% of active managed funds, a little bit more, beat their benchmarks. But mostly we have 27, 33, 32. In 2016, about 30% of actively managed funds. This is where you're choosing stocks to beat the market. So if only 30% of actively managed funds beat the market, 70% of actively managed funds didn't. So a good, on average, in general, actively managed funds don't beat the market. And the result is, on the right, we see that in the blue, passive managed funds will soon overtake actively managed funds. The projection in this chart is by 2020. So in the last few years, certainly the last almost 20, passively managed funds have accelerated in terms of gathering assets. This is Burton Malkiel. Burton Malkiel is a professor of economics at Princeton, a very influential economist. He wrote the book Random Walk Down Wall Street, an influential book in finance, very influential book. It posits that, if you threw darts at a chart of stocks on the wall, that it would do as well as one hand-picked by someone. That seems crazy, right? Well, let's take a look at what he says about the efficient markets hypothesis.
First of all, our markets all over the world are reasonably efficient. When information arises, they get reflected really without delay in market prices. And also, because active managers charge very much more than passive managers, and because there are costs in moving from security to security, it is too much to expect them to outperform a passively managed index, and the fact of the matter is they don't.
Now, in fairness, Malkiel, his hypothesis, his book Random Walk, and his career has been about building around the efficient markets hypothesis. Not everyone agrees, and clearly some actively managed approaches beat the market. But what he's saying is that it's largely efficient. The market is largely efficient. In the example I gave before, I forget what year it was, 2009 or 2016, 30% of actively managed funds beat the market, but 70% didn't. And Malkiel points out the value of keeping costs low and trying to get the average return of the markets.